Though I'm not going to ask you to be able to solve this for me ever on a test, I do want to make sure that we understand exactly what we mean by a progressive tax system in the United States and how income tax actually works, because there's a lot of misconceptions behind it, and I think a lot of people don't truly understand how it works. So let's say that you are single and you have an income after all your deductions of $122,000. So what we would say is your taxable income is $122,000. Whenever you go to do your taxes, first and foremost, anymore, they just have like a computer program you can plug it into, so you don't actually have to do all of this by hand. But if you wanted to do it by hand, here's what you do. They would give you this tax table, and this is what it looks like for single filers. What we mean by single is you are filing as an individual. You can file married separately. You can file married joint. There's a couple different options you have. But this is our tax table. And a lot of people have the misconception here that the way this table works is they just look at it and they say, okay, I make $122,000 and $122,000 falls into, there it is, 24%. So 24%, is because my income's between $82,500 and $157,500. So I would pay 24% of $122,000 and bam, there's my tax. And that is actually not how it works. This is a progressive system because what you're doing is you are paying a percentage of your additional income. So let's sort of explain what exactly that means. What you do is you pay those percentages on different sections of your income. So here's what we would do. We look at that first row and it says that you pay 10% on any money you make from $0 up to $9,525. So that's that first little stack right there, right? So we have $9,525 right there, and we pay 10% on that. So of that first $9,525, we pay $952.50 in taxes. Then we go to that next chunk, and that next chunk is any money we make between $9,525 and $38,700. Well, for us, our income is over $38,700, so we do pay taxes on all of that portion, and that difference there is actually $29,175, and we pay 12% on that. Well, 12% of $29,175 is $4,376 and 25 cents. Then we go to this next chunk, and that next chunk says we pay 22% on any income we make between $38,700 and $82,500. Well, again, our income is over $82,500, so we would pay taxes on that whole entire section. That whole section is made up of $43,800 at 22%. That equals $9,636 in additional taxes there. And then it says we pay 24% on any money we make between $82,500 and $157,500. Now our income stops at $122,000, so we would only pay taxes on money, that last portion of our income, which is $82,500 up to $122,000, which is $39,500. And so we would pay 24% on that. So that's an additional $9,480. Then what we do is we would add up all four of those different sections of taxes, and we would see that we'd pay total in taxes $24,444.75. And our average tax rate, or that percentage of our income, actually comes out to be 20.04%. And so really what that means is that we are not paying 24% on our income like you might have incorrectly thought, because we're paying on additional income. So each of those different sections, and then we add it up from there. And that's why it's a little bit complicated of a process. And that's why it's really nice just to throw your income statements into TurboTax or send it to some tax accountant. But how does this all play into our GDP? And this is really going to come in Unit 6. Because if we think about GDP, we said it's made up of the C, the I, the G, and the X minus M. Well, first and foremost, we want to consider how taxation affects the C, right? Because if you think about it, say the government was to decrease our taxes. If the government decreased our taxes, that means people like you and I have more disposable income. We have more money because we have less money that we're paying to the government. Well, if we have less money that we're paying to the government, we have time for more consumer spending. We have more money to go buy more things. So if that C is going to increase, that would cause GDP to increase. But the same thing is true the other way. When we increase taxes, we see that we have less disposable income. So you and I have less money to go out and go spend on stuff, and therefore we would do less consumer spending, and that would slow the rate of growth for GDP. But at the same time, we see those changes in government spending also have an impact on our GDP. Because as the government starts spending more money as their budget goes up, we see an increase in GDP there. But as they spend less money, we see a slowing of the GDP. And so this is all going to come into play a lot more when we get into Unit 6, because in Unit 6, we're going to talk about specifically how the government intentionally manipulates taxes and government spending in order to impact our GDP.